It was a pretty wild day on Wall Street with all four of the major equity indices having a range today of greater than their average true range over the last several weeks. So a lot more volatility today. It was definitely a risk off type of a day where we saw things like utilities and REITs and gold outperform, but more cyclical things like oil and industrials and technology underperform. Now, a lot of the consternation was as a result of some rumors spreading around that the Democrats might bring up impeachment possibilities for Donald Trump. We're actually going to learn a little bit more about that with Nancy Pelosi's speech that she's got coming out here, likely when I'm recording this video. So by the time the markets open tomorrow morning, we might find out a little bit more about that. But as it stands right now, we have bullish postures on the S&P 500 and the Dow Jones. But after today, we now have bearish postures on the NASDAQ composite and the Russell 2000. So I'm going to look at all of that. We're then going to put together a trade application example in one of the commodities that's starting to perk up here recently. So with that, let's go ahead and get started. Welcome to Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 24th, 2019. If you're new, first of all, welcome aboard. Go over to YouTube, click subscribe on our channel. While you're there, check out our description area where you can sign up for our email distribution list to receive a daily reminder when these videos are posted, and also gives you a heads up on what stocks in the S&P 500 are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee, and we certainly appreciate those of you that click like and retweet on these Market Outlook related tweets on a daily basis. Lastly, we have a presence on Facebook as well. Feel free to join us at the group embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. And as a reminder, I did release our latest charting package, which includes 46 charts to all of our premium members here. So you can see all of these right here, all of these right here, and then a big chunk of all of these right here. So if you are a premium member of Market Scholars, a yearly premium member, which most of you are, feel free to go to our main charting tutorial document on the resources area of our blog for further instructions on how to import the brand new charts that David and I will be using going forward. This happens to be chart 4B. This is our market forecast kind of foregrid that we're looking at here, and this will allow us to see a number of things, including the daily price action. So one of the things I mentioned in the intro is notice how the label, the last label on all four of these charts is orange as opposed to blue, and that occurs when the daily range is more than the average true range, and it gives us a sense of whether today was a more volatile and wild type of a day in the market, and as you can see, it certainly was. The daily range, for example, in the Russell 2000 was 32 points, when typically it only moves about 21 points. And you can see how ugly of a candle that was as well. Not only was the range large, but we closed near the low of the session. That didn't help matters much. You can see in doing so, it pushed that green intermediate line into or out of the upper reversal zone. It's back into kind of the middle zone there between 20 and 80. So since that green intermediate line is at 75.59 and falling, we now have a weekly bearish posture on the Russell 2000. Same thing can be said for the NASDAQ composite. You can see over here, that was a big enough of a move lower. We moved within a range of 189 points today on the NASDAQ composite. We actually ended up closing just a hair below the moving average today as well. Now that moving average is still rising, and so that's why the moving average is painted yellow here. But nonetheless, not a great sign that we closed below the 30-day moving average on the NASDAQ. And notice that's the only one of these indices that you can make that claim for. So, you know, one of the things that we've been experiencing in recent weeks is the breakdown of this growth trade or the momentum trade that I brought up with you guys a couple of weeks ago. And that continued today as well. If you own any cloud computing types of stocks in your portfolio, without a doubt, you probably felt a little bit of pain today. That was one of these, risk off types of things that we've been looking at here more recently when money starts flooding into more safe havens and flooding out of kind of where the hot money was before. So anyway, the NASDAQ and a lot of those technology-oriented stocks are taking the brunt of this move lower a little bit harder than the other areas of the market. You'll notice that the charts up here still have a green background, unlike the two bottom charts. So for the S&P 500 and for the Dow Jones, we retain a bullish posture, but even that is starting to come into question. You'll notice the green line is still in the upper reversal zone on the Dow, but it's at 83 and falling, and then on the S&P 500, it's at 85 and falling. Remember, once those lines get below 80, that's when our posture would then revert back to a bearish posture. So right now, we're still okay, and it's good to see us still trading above rising moving averages, but obviously things have deteriorated a little bit here in recent sessions. In fact, one of the things that I'm sure a lot of technicians will be looking at is the fact that we were unable to hit a new all-time high in this most recent move. You'll notice that the high label on these 3-month charts that you see in front of you still go back here till late July. And so after a nice little rally out of August there, kind of had the feeling that we were going to be gunning for new all-time highs. I think that was kind of the prevailing assumption at that time. Well, you know, we're looking back now after the last couple of weeks, and we're starting to wonder if maybe that wasn't so much of a an expectation at that time. So we'll keep our eye on it right now. You know, there's obviously a lot of geopolitical concerns with the impeachment possibility that I mentioned before, and that has the ability to impact market participants. Remember, market participants don't like uncertainty. It's not necessarily impeachment by itself that is concerning. Remember that the stock market, if you would have asked it before November of 2016, if it wanted Donald Trump as a president or not, I think most market participants would say absolutely not. Yet what we saw was a massive market rally once Donald Trump was announced as the president. So it was the certainty of that that was kind of the kicker there. And so it's kind of interesting now all of a sudden you start hearing these impeachment rumors and then the stock market falls, right? You know, they didn't want Trump in the first place, or at least they didn't think they did, and then the stock market went up to all-time highs, and now when there's the prospect of possibly kicking him out of office, then the stock market falls on that. So, you know, there's confusion as always, but a lot of it just revolves around uncertainty. Market likes more certainty, not less of it, and right now we're kind of in a fluid situation. All right, let's take a look at another chart setup here. Let's go on over here to the 3 green arrows chart. This is chart 4D on the new setup here. As you can see, we have a 3 red arrow signal on the NASDAQ composite that you'll want to be aware of as of today. And of course, the reason for that is, as I mentioned before, price closed below the 30-day moving average. We also received another red arrow in the form of a stochastics red arrow down below. And remember, we already had a red arrow on the MACD histogram from a couple of days ago. So that completes the 3 red arrow signal right there. The other charts, we don't have that. We do have 2 out of the 3 indicators red on all 3 of the rest of the charts, and those 2 are, in each case, the MACD and the stochastics. The moving average is kind of the saving grace there because price remains above the moving average in all 3 of those cases. But again, because we're going to be looking back and saying, okay, was that a bit of a double top that we were dealing with there? Right now, we're just kind of in limbo. We're in no man's land right here. And perhaps these are good environments to be thinking about iron condors like I did in the last video on Thursday, where we don't have a breakout upside or a breakout downside. And perhaps we're just playing the ranges in the middle until we can find those breakouts. Moving right along now to our next chart setup, let's go ahead and do chart 4B in this case. This will be or actually 4C, my apologies. I'm still getting used to the new order here. It's 4C will be our moving average crossover chart. And the moving averages that we use are the 10-week moving average and the 40-week moving average. The 10-week is represented by the orange line on the chart, and the 40-week is represented by the blue line on the chart. As it stands right now, the same thing that I've been mentioning in the last several weeks still continues to hold true, which is the only one that continues to have a bearish crossover is the Russell 2000. That's the only one where we got that pink background color that signifies that at this exact moment in time, the 10-week moving average is slightly lower than the 40-week moving average. But you can see how close we are to crossing over to the positive side. Now, of course, if we have more selling this week, it is possible that we don't get that bullish crossover. We're right there where you would think that it's an inevitability, but there are no guarantees, especially with the news. I know David retweeted, I think it was Ryan Dietrich here, over the last couple of days mentioning that this exact moment in time, this week, historically, has been a little bit of a weaker time period for the general stock market if you compare it to the rest of the days on the calendar throughout the rest of the year. So, kind of the end of September is usually a little bit more of a precarious time for the general stock market. And, after today's move, it makes you wonder if we're kind of setting ourselves up for that to play through yet again. The other charts are still in good shape in terms of the crossovers are still bullish for the long-term investor. All right, moving right along now. Let's go ahead and do some 12 grid analysis. Let's start with chart 5A. This is our asset classes 12 grid. And the main thing that we're looking at here is kind of breakouts and bounces and different things like that. Now, as a reminder, with this new chart setup, 5A, things will look a little bit different than they had previously in that there's now 4 different background color possibilities. In the past, we had only been using 2 simple ones, either pink or light green. Now we have dark green, light green, dark pink, and light pink. I don't have any dark pinks to show you on this set of 12 grids, so we'll see if that will exist in any of the others. But as a reminder of what all those combinations mean, when you see the dark green, like we see here as an example with foreign bonds, note that the intermediate line is at 52.67 and rising. So remember, we would consider that strongly bullish according to the market forecast intermediate line. Anything where we get the line rising above 50 or just simply anything above 80 we would consider to be strongly bullish. If the intermediate line was rising somewhere between 20 and 50, then we would consider it weakly bullish. So as an example over here to the left with long-term US Treasuries, note that the intermediate reading is at 39 and rising. So that's why that background color is a lighter green than that background color that's a darker green right there. And then the light pink, like you see on 3 of these charts here, represent weakly bearish charts. In those cases, we have an intermediate line that's somewhere between 80 and 50 and falling. So like with oil here, it's at 56 and falling. But if we ever had one where it was below 50 and above 20 and falling, then that would be a darker pink background. So it might take you a little bit of time to kind of get used to that new view, but it just kind of allows us to add a slight nuance in addition to what we had been doing in the past. Now, as far as the trends go, I would say that the best looking trends on the chart right now probably belong to preferred stocks don't look bad. Now it's a little bit kind of a more chaotic chart where you have some pretty violent moves down in 2 of the cases in the last 3 months there, but that is heading in the right general direction, I would say. I would also say that foreign bonds, after having a little bit of a time out there in the last couple of weeks, we did manage to pop our head above that rising moving average all of a sudden here on BNDX, and it looks like we're going to kind of fall back into that trajectory that we were in previously. So that one looks strong. Real estate looks pretty strong as well. We were down a little bit in real estate today, but it did outperform other sectors that were out there. So we still are above a rising moving average. I would say that the US dollar remains in a fairly significant uptrend. And then last but not least, I would say gold looks really promising here as well. Gold kind of pulled back in the last couple of weeks as the market kind of was in a better mood and it was more of a risk-on market and things were going back towards the cyclicals, et cetera, et cetera. Well, all of a sudden today when the investors and traders kind of step on the brakes a little bit, that's when you have an opportunity for money to flow back into kind of those safe havens like GLD right there. So put a pin in that. We'll talk about that one a little bit later as well. Before we do, let's go ahead and talk about another set of 12 grids. In this case, let's go to the U.S. sectors 12 grid. All right, so as you can see here, we've got kind of 3 charts that are dark green, and all the rest of them are that light pink color. So the charts that are dark green, somewhat interestingly, are the U.S. stock market itself. So that's SPY in the upper left-hand corner. That one's getting very close, by the way, to going pink, as I mentioned before. We're at 81 and falling right now on SPY, which is a slightly different reading than SPX, but they're generally kind of, with the same pattern. So anyway, if we get a couple more sell-off days in SPY, that'll likely go back to a bearish posture there as well. But what's kind of interesting about it is usually you're not going to have 9 out of 11 sectors with a bearish posture, yet SPY maintaining its bullish posture. That doesn't happen very often. It can only happen if those that are bullish happen to be very important pieces of the market, and that is the case with the financials. The utilities aren't really that important of a piece of the market. They're one of the smallest sectors out there, both from a components perspective and also from a market cap perspective. But the financials are one of the biggest sectors out there. They're not quite as big as technology now that the REITs have been pulled out of the financials, but nonetheless, financials are definitely in that top tier of sectors from both a total components perspective and then also from a market cap perspective, if you think about the big behemoths out there like JP Morgan and Wells Fargo and what have you. So anyway, that's likely what is allowing SPY to retain its bullishness right now. Now, obviously, when you look at these two charts from a sector perspective of which one looks a little bit healthier, either the financials or the utilities, you know, even a third grader would be able to tell you the utilities look fantastic. I mean, that is quite the breakout there in utility land here today. We were up 1%, 1.17% on XLU today, and it's kind of just dancing to its own tune right now. It doesn't really care that the stock market was down nearly 1% today. Utilities caught a nice little pop higher here today. Real estate also outperformed. However, real estate was down 0.13% today, but on a relative basis, that's clearly an outperforming category. You also saw the staples finish higher here today. They were up 0.41%. So those three down there at the lower right-hand corner are placed there as a result of them kind of being known as more defensive, oftentimes interest rate sensitive areas of the market, and they will generally outperform on a relative basis when the rest of the stock market is struggling, and that is certainly kind of the playbook that was exercised here today. Now, real quick, if I go off script here just a second and go over to the internet, wanted to show you on the sector selector. Remember, I put this together on Friday nights after the stock market closes, and it's based off of weekly information, but this will take us back kind of over the last 3 months on a week-by-week basis to see what the ranking system has shown us from this particular perspective. And remember, this is different than just simply looking at a chart of those big ETFs like we were a moment ago. It'll provide a slightly more in-depth view with some different technical indicators involved in the ranking process. So as of Friday night, you'll notice that utilities went from number 2 to number 1. So remember, I had no foreknowledge of today's big move in utilities when I put this together on Friday night, yet it was already giving us a heads up as of last week that utilities were starting to swing back into favor. It was also impressive that utilities were able to maintain the second ranking for 2 months straight before doing that. Remember, the real estate stocks actually fell out of favor there for 1 week when we had that big transition from kind of the momentum and low volatility stocks back into the value stocks. And so they kind of fell out of there. What was impressive that week was that the utilities, which oftentimes move kind of in unison with real estate stocks, actually held their ground. They held that second ranking at that time. So that's kind of the big news there. One of the things I was curious about last week as of Friday when I put this together was whether energy would have what it took to get off of the last place position, because remember, it was last Monday, so it would have been included in last week's rankings when we had that big surge higher in energy prices based off of those drone bombings over in Saudi Arabia, but it just simply wasn't enough. And then today you can see a lot of those energy stocks selling off right there again. So again, I know a lot of people want to take a stab at those energy stocks and do a little bit of bottom fishing. But so far, it just has not been shown to be profitable to do that. And a lot of those oil and gas stocks just remain stuck in the mud until we can see some legitimate bottoming taking place. Also, while we're over here on the internet, I do want to say thank you to those of you that clicked like for me the last time. Now, there was only 83 of you that clicked like. As you guys know, my bogey that I'm shooting for is usually 100 likes there on Twitter. So we were really light the last time around. So I didn't think the trade was all that bad. And Iron Condor on Merck seems to be holding up just fine here. So for those of you that didn't like it, that you typically do, make sure you try to get into that habit of doing that. Remember, David and I kind of use the likes on Twitter to judge whether you guys want us to do these videos or not, right? These are free videos that are on YouTube. We got to kind of have it both ways as far as if we're going to put the 2 and 3 hours together to put the videos together for you, then you've got to be able to do something for us. And all we ask of you is just to simply take 5 seconds out of your day and click like for us on Twitter. Those of you that do that for us on a daily basis, we thank you. We appreciate that. It helps us get the word out about our premium offerings to a wider audience than we'd be able to otherwise. But the question we always have to continually ask ourselves is, does it make sense to do these videos every single day? Or does it make sense to do these videos, let's say, once per week on the weekend? For those of you that want to see these videos done every single day, I would encourage you to click like every single day. So it's your way to vote for whether you want that to continue or not. So thank you to everybody who did that. I hope more of you will continue to do that in the future. Also, real quick, I did teach my dividend growth investing class today. We had one very controversial company versus another kind of steady Eddie type of a company within the consumer staples space. So if you are a member of Market Scholars, whether it's a plus member or a premium member, you should have access to that on the recordings. David also taught his directional option strategy earlier today. Tomorrow on our schedule, we've got the options inventory trading class that David teaches at 11 o'clock Eastern Time. And then I'll be teaching my factor-based swing trading class tomorrow at 2 p.m. Eastern Time. And we've been on quite the hot streak in that particular class. We've now successfully closed 16 out of our last 19 trades at a profit, even though we're only taking 1-for-1 reward risk possibilities there. So the trade that we did last Wednesday, we already closed out of at max profit. So we always like that when we can close them out before we even get into the next week's class. So anyway, feel free to join me for that if you are a premium member of Market Scholars. All right, getting back on track with some of these charts over here on the Thinkorswim platform now. I wanted to point out some of the factor-based information that's taking place as well. Real quick here, let's take a look at chart 3D. This is your factor 6 grid. And one of the things I wanted to point out is there's a little bit of a divergence taking place right now between low volatility and momentum. And for folks that have been attending my factor-based swing trading class for the last several months, they would tell you that those two had generally been traveling in the same direction. All of a sudden, they're starting to separate a bit from one another. And as you can see here, low volatility continues to hold up reasonably well. It was down today, but it was only down 0.17% today. That was obviously a market outperformer compared to like the S&P 500. Whereas when you look at the momentum factor, that was a pretty ugly breakdown type of a candle that we saw there below that moving average. So I chalk that up to a lot of the technology-oriented companies that I mentioned before, a lot of those kind of cloud computing types of companies. They really struggled here today, and we're starting to lose that leadership group right there. So right now, this is kind of a market that continues to be in transition from a factor perspective as well. In fact, if I were to pull up, let's just pull up chart 4A here real quick. And, you know, if you want to look at some of the so-called hot stocks of the summer, you know, stocks like the Trade Desk was down another 5% here today. Okta was down 2.6% today. Workday was down 4% today. Atlassian was down 5% today. So a lot of ugly looking candles there, and those had once been the momentum stocks of this market. We're starting to lose that leadership here, so you got to be a little bit more careful in those arenas. All right, so that then brings us to our trade application example here for the day. And I mentioned previously it was going to revolve around a commodity, in particular gold. Gold has been impressive. In fact, you'll notice that as I pull up ticker symbol GLD here, that the last couple of days we've started to bounce above that rising moving average again. It looked kind of for a while like it was getting a bit dicey. Most of you know that gold has been in quite a strong uptrend for much of 2019, but in the last couple of weeks we kind of started to lose a little bit of that momentum, and you saw, you know, 4 straight down days here as an example. Then all of a sudden we're trading below that moving average. Now the good news is it didn't start plunging. It kind of started using that moving average almost as kind of a magnet. It refused to go much lower than the moving average, even though it was mostly hanging out just a hair below it. Well, the last 3 days, you can see we've had a nice little jut higher out of gold there, and we now are at a nice little place here where it feels a little bit more comfortable to enter into bullish positions. Again, you can see that background color of the chart just changed to green once again, letting us know that this green intermediate line has started to curl higher there again. Now it is a lighter green background color there, and the reason for that is the intermediate line is at 46.54 and rising. Remember, once it gets above 50, it'll start turning that dark green color like this again. So, assuming that this chart doesn't break down, if we continue to coast higher, we should see a dark green background here within the next couple of days on GLD as well. So what I wanted to do with GLD today is something that's known as a bull put spread. And so in order to do that, I'm going to come on over here to the trade tab. I'll show you what I've got set up. So I'm using the November contracts now. These are the monthly contracts that have 52 days left until expiration. I am pulling up the 140 strike as my sold strike. So you can see how I've got this established down below. I'm selling the 140 put, and at the same time I'm buying the 138 put. I'm receiving a credit of 47 cents for this credit spread here, otherwise known as a bull put spread. And generally speaking, what we're looking for is a 30% return on risk. So if you click confirm and send once to get to your order confirmation dialog box, you can see that as you start doing the calculations, if you take the max profit, in this case with one contract, it's $47, divide that by the max loss, in this case with one contract, it's $153, and you can see that that's perfectly just a hair above that 30% return on risk hurdle that we're shooting for. So it would be deemed acceptable at this particular level with these with the strike prices priced how they are as of today's close. Now again, keep in mind I'm doing this video after hours on a Tuesday, so who knows where the gold market opens on Wednesday morning, but as of this moment in time, this would be viewed as an acceptable trade setup. Now some of you might be wondering, where does that establish us on the chart? Notice right here the break-even price, if we were to conduct that trade, is 139.53. Now for those of you that are new, what we're doing here is we're selling a spread, and it's called a bull put spread because even though we're using puts, it is a bullish strategy. We're receiving a credit up front, and what we're hoping to accomplish with the trade is simply to have the underlying security stay above the break-even price. In this case, we want GLD, which is currently priced at $144.51, to stay above $139.53 for the next 52 days. So let's see where 139.53 is on the chart. And you can see 139.53 would be at around kind of this area right here. In fact, let me draw that on there so it's a little bit easier for your eyes to see. I'm going to use a price level here, and we'll just draw a line, and then I'm going to right click and edit it, and it was 139.53. And you can see right there that dotted blue line will represent kind of our line in the sand where we do not want GLD to go. So if you take a trade like this, you would likely win that trade as long as GLD does not breach that blue line down below there on expiration day. And with this current momentum taking it higher and a little bit more nervousness in the general stock market, who knows, maybe money will start flowing back to gold a bit more, just like we saw earlier in 2019. So let me come back on over here, place the trade by clicking confirm and then send one more time. All right, well, thank you for joining me here yet again. Again, it was kind of a wild day in the stock market, some possible rumors of impeachment. We've got a lot of things going on right now in terms of trade wars and what's happening with the UN, and lots of stuff to keep us busy as far as keeping our eyes on the market. But one thing that you will want to be aware of is that the Russell 2000 and the NASDAQ both have bearish postures now, whereas kind of the more blue chip areas like the Dow Jones and the S&P 500 retain their bullishness. So anyway, we're kind of at a little bit of a no man's land right now, and we'll see what the news brings our way here. But for right now, gold looks like an interesting trade setup. So that's what I had for you tonight. If you got value out of tonight's video, again, please click like for us over there on Twitter. It should be pinned to the top of my timeline, or you can do it right there on our website as well. So thank you so much for checking out the video here tonight. David will be back with you tomorrow, and I'll see you on Thursday. Take care, everybody. Bye-bye.